You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. He's speaking to us from Gulf Shores, Alabama. Welcome back to the show.
Jim, as always, thanks for having me.
What's going on? The stock market is rallying, and yet we have all these tariffs flying around. What's the story there?
Well, Jim, we had a primary bearish trend change back in February or early March, I should say, and nothing has changed. There's always a rally that tests that setup, and that's what we've seen in the cyclical world. We had some cycle lows that occurred a little early in April, and we've seen the rally out of that lows, depending on what perspective you want to look at it from. And it's a counter trend rally. The bottom was engineered, if you will, with Trump giving us a pause on the tariffs, and it's the same sort of thing. If you will recall, back in 18 and 19, people don't remember this, but they can Google it and look it up. But throughout 18 and 19, as we were pressing into that top, it was the most frustrating thing. Because you're looking at the cycles in the market, and it'd set up, and they'd blow it out, and it'd set up, and they'd blow it out, and it was comical, really, from my vantage point, that Trump would announce we have a deal. Well, we don't have a deal. Well, we have a deal, and and they were in a meeting, and they'd come out of the meeting, and they'd announce, well, we have a deal. We don't have a deal, and it went on for 2 years. With the tariff yo-yo, if you will. And this is the same thing. It's the same thing. We're seeing more of the same. And these tariffs, people think that they are, I think they think, well, hell, I don't really know what people think, but the consensus that I see is that people think that they're good, and that making America great again and bringing jobs back. And it's not that I don't believe in domestic production and manufacturing and that sort of thing. Of course I do, and I disagreed completely with what went on in the 90s with shipping the jobs overseas with NAFTA and GATT and all that. But the fact is that we are where we are now with this situation, and these tariffs, it's destructive. It's not. People are not going. Let me ask you this: would you invest if you were let's say there used to be a sock manufacturer in North Alabama, for example, and they're gone. I don't know the name of the company. I'm just aware of it. But would you go and reinvest the millions of dollars it would take to reestablish that plant? And I'm sure the machines and all that stuff is gone. But let's say you had to bring this plant up. You have to secure the property. You have to secure a building. You have to, bring all the manufacturing facility up to standards and get everything going. You got to staff the thing. You got to get it. You don't do that with the twinkling of the nose. It takes, we're not Samantha here. It takes time to bring all this stuff up. Are you going to make that investment when you have the uncertainty with, oh, we have a deal, we don't have a deal? Oh, well, we'll just take those tariffs off. Well, now, I mean, who's going to make that? Who's going to legitimately make that kind of commitment to bring the manufacturing back to the U.S. when it's like a yo-yo? And so this has created tremendous uncertainty. The tariffs themselves are deflationary as hell. If you look back at like the Smoot-Hawley Act of 1930, they were extremely destructive and deflationary. And I can see where in the current case, and I talked to an economist about this, and this made perfect sense. He said overall that, yes, the tariffs are deflationary, but it depends, in some cases, depending on the goods, an inelastic good, a necessity, a basic, something you have to have. If it's a certain, let's just use a simple example. Let's say a part on your car. Let's say you need a fuel pump. Well, you're not driving your car, period, if the fuel pump goes out. So that's kind of an inelastic good. So, if that part's made in China and you can't get it, and you have to have it, then the price of that part is probably going to be through the roof. But let's say a tail light goes out. Well, you don't have to have that. The law is probably going to frown on it, but you can still drive your car without a tail light. And so I can see where this is both inflationary and deflationary, but overall, the net effect is it's destructive and it's deflationary. And what has happened is that by putting this pause on the tariffs, the market has rallied, perceiving this as a positive thing, and it's just a counter-trend relief rally. It's the same thing that we saw back in 2018 and 19, and it's Act 2. But I think the difference between now and then is that we have seen a primary bearish trend change. I think this is counter-trend, and we are turning down out of that six long-term economic cycle. And so what I think we are seeing is in effect, a controlled, if you will, I don't know how to say this, but like a controlled demolition, if you will, or unwinding, a controlled unwinding of the bubble, and that maybe they're trying to just kind of let some air out and then contain it while they do it. In my opinion, that's what we're seeing.
Now, how do you get back business partners who have decided, okay, the threat of tariffs, I'm going to find a new place to sell my goods instead of the United States? Does that ruin these partnerships for years or forever?
I don't have the answer for that, but I think it certainly damages that relationship, if I'm understanding you right, for the U.S., because how can you again, it creates uncertainty when you have a tariff and then you don't, and then you do, and then you don't, and then you do, and then you don't, and then you do, and then you don't. I mean, really? It's bullshit. And everybody is cheering it on like it's good to bring the jobs back for America. Well, yes, of course that's good. But it's unfortunately it's not that simple, and it's created tremendous uncertainty. And nothing has changed. Like I said, we have this ginormous bubble. Things we're set up to try to turn down out of this long-term economic cycle, and all this did was create a counter-trend rally in the process.
Now, 16% of Chinese exports go to the United States. So if it would be a huge hit to their economy not to export to the U.S., but the Chinese government says we have survived much bigger crises in the past than just a huge tariff on our goods. Again, we'll look for other markets and exploit them. Is that a danger to the U.S., where countries turn to China instead of the U.S. to do business?
I suppose it is, and it looks to me like if that's the case, that's destructive. But here's the problem for the U.S. I happen to be checking the oil in my vehicle. I have a Chevrolet red, white, and blue USA American pickup truck, right? And I was just checking the oil, and lo and behold, I looked down, and I noticed the belt. It was a Gates belt. Well, Gates, everybody that knows anything about vehicles, they know that Gates makes hoses and belts. Red, white, and blue America, right? You want to guess where that Gates belt was made?
Shanghai?
Exactly. China.
Yeah.
And then I noticed the belt tensioner. I see it there, and I got to noticing. It's like when you see a yellow car, you see a bunch of yellow cars, and I see the tensioner, and it had stamped right on it, made in China. So, the problem is that I think this is a kind of I don't know how else to say it, but it sounds conspiratorial to say it, and maybe it is. It's a stealth takedown. Again, on the one hand, I agree. I mean, Gates should be making their belts in Ohio or something. You know what I mean? But unfortunately, they ship that manufacturing facility to wherever in China, and now we're dependent on that. And if you cut it off, it's going to be a tremendous supply chain shock. And this is not good. Again, it has created the uncertainty, and the markets don't like uncertainty. and I think that's where we're at. And on that note, I know people. Now I can't say firsthand because I'm not there, and I can't verify this, but I have heard from a couple of people that I know that are related to the shipping industry, and they're telling me that friends of theirs and themselves and different ones are talking about how they're personally seeing a decrease in the volume already of the container ships coming in. So again, I can't verify that. We've all heard that sort of thing, but I've heard it from personal sources as well. So again, I think that this is maybe we're destined, it looks like, for the kind of thing that we saw with COVID, but perhaps worse because of the supply chain issues that this could ultimately cause.
Now, President Trump wants to bring back aluminum and steel manufacturing to the U.S. Who's going to staff those plants? Because I'm just looking at this. A Morning Consult survey of 1,000 Gen Zers said 57% of them want to be influencers. No mention of a steel worker or aluminum worker.
Well, that was my point.
Yeah.
With the analogy with the sock company.
Yeah.
I mean, what are you going to do? Just drop this steel manufacture? I mean, I agree with it. I agree. We need to make more steel in America. We need to make our belts and hoses in America. We need to be more. It needs to be like it used to be. We need to be a manufacturing, based economy. But unfortunately, we're not anymore, and you don't just drop a steel manufacturing facility out of a helicopter and staff it with people overnight. And so, again, this takes time. Where are you going to get the people? It takes decades to make that transition. And so that's my issue with it.
Yeah, well, Canada's aluminum mills are based around hydroelectric production facilities because you need a tremendous amount of electricity to make aluminum. Where's the U.S. going to get this extra electricity? I mean, California every summer has rolling brownouts.
Right. I agree. I totally agree.
We'll have more with Tim Cyclesman Wood right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. The Fed did not lower interest rates when they last met in the past week. Everybody's saying, oh, my God, that's going to drive the country into recession. Does it work that way? Do you have to lower rates to keep recession at bay?
I love it. I absolutely love it. Jim, when you look at the data and you look at history, people are so stupid. When you look at the data, it just these urban legends and myths and things that people perceive to be true are just not generally true. And with interest rates, let's think about this. Let's go back to 2000. Let's look at just 25 years of history. Every time the Fed has lowered rates, why have they been lowering rates? Well, first of all, the Fed follows the 3-month T-bill. And everybody says, oh, it has to do with employment, and it's this and it's that, and that's bullshit. The Fed follows the 3-month T-bill. And the reason they haven't lowered rates is because there's a spread differential between the 3-month T-bill and the discount rate. And while they have, as we have progressed through time, that spread guides them. But used to, we would be between 1.5 and 2 point differential, and they would start their cuts. But as we've progressed through time, that differential margin has narrowed. And the last 3 cuts that we saw in this rate cutting cycle that has begun were the most unprecedented rate cuts going back to the inception of my data back in the 1950s. So they have become much more aggressive in their cuts, but the fact that the 3-month T-bill has kind of what am I looking for here? Levitated here. It hasn't continued down. Is the reason they haven't cut. And then looking back, another point I want to make here. Coming back from the 2000 top, which was the downturn out of the previous long-term economic cycle, we've talked about this, and then from that 2002 low, the current long-term economic cycle was born, and we've seen a couple of attempted downturns out of that cycle. The first one being 07, which resulted in the worst financial crisis since the Great Depression, and the second attempted downturn occurred in 2020, and we know the story there. And all of these incidences, including the 2000 top, what did the Fed do? They cut rates. Well, why did they cut rates? Well, one, the T-bill rate had started to decline. But number two, they cut rates because they are trying, in effect, I mean, this is kind of a double-edged sword. I don't mean to speak out of both sides of my mouth. They cut rates because of the market forced them to cut rate. The T-bill rate forced them to cut the rate. That's the fact. But the other point of it is that it tends to be, or it's perceived as stimulus. I don't know how else to say it. They're trying to reinflate. It's a reinflationary effort. So, and then you have to ask yourself the question: well, if things are so great, why are they having to try to reinflate? And so it's a sign. It's another sign of the times, and that something is not right. It's not the positive, merry thing that everybody makes it out to be. Perception is not reality. I mean, it is, but it isn't, if you know what I'm saying. And so the fact that everybody that people perceive the Fed cuts as being positive, yeah, it kind of sort of is, but on the other hand, the underlying reasons behind it are not positive, if all that makes sense. So I don't know if I answered the question, but the long and short of it is the reason the Fed didn't cut, and they're not going to cut until the 3-month T-bill starts back down, and I can tell you when that spread differential gets between 50 and, say, 75 basis points, and certainly a point, you can write it on the calendar that you got in front of you, they will cut. And until then, they're not. So that's the reality of the rate cuts. So I don't know if I answered the question or not.
Now, Treasury bills are an international commodity, so basically it's a comment from the worldwide community, not just the U.S. when it comes to the T-bill 3-month rate?
Well, I'm not sure I'm following your question. What are you trying to say? I'm not sure I'm tracking what you're saying.
Well, anybody can buy or sell T-bills on the planet.
Right.
Yeah. So is it a comment on what they think is happening with your economy with their purchases or non-purchase?
I think it's a demand. I think it's probably a demand for liquidity. It would be my perspective on it.
What's your outlook for gold?
Gold, Jim, as you know, gold has done very well. I'm not dismissing that fact in any way whatsoever. We had a 9-year cycle low in gold back in my lens just fell out of my glasses and I can't see. Back in 21 or 22, I forget which it was, 21 I believe, and gold has been doing very well ever since. But let's go further back in time than that. Let's go back again. Let's go back to 99, late 90s, and into 2000. The gold made a long-term cycle bottom in conjunction with one of the dominant long-term cycles in gold is a 9-year cycle. It bottomed in 99, ahead of the peak in equities in 2000 and the decline into the 2002 low, and the efforts to reinflate that followed. And so, in a sense, if you will, gold foresaw with the bottoming in 99 and that uptick, the inflationary efforts that were to follow. And so gold has been in a tremendous upswing ever since. And so it's in effect, it has served as an inflationary hedge, and has served very well. But again, it's because of these extreme inflationary efforts to keep the system going. We've talked about that. It's inflate or die. The system, it's a fiat debt-based system. And in order for it to survive, we have to have it has to be fed by debt and inflation. And without that, the system dies. And so that is what we have seen coming out of the 02 low, and then certainly out of the 07 low, and certainly out of the 2020 low. Look at the stimulus. Look at the QE. Look at all the stimulus packages that came out of COVID. Look, that's all inflationary, and that's what has fueled gold higher. Now, we have to ask ourselves the basic question. Why did they do that? Because they didn't want the system to deflate. And so they were able to kick the can down the road, as they say. But the overhanging risks to the market, or the overhanging forces, are deflationary. And so if and when, it's not a matter of if, it's kind of when, but if this the current long-term economic cycle, the downturn bites here, then by default, if that deflationary, boogeyman bites, that the deflationary force takes hold, and these inflationary efforts begin to fail, then by default, gold is going to suffer in that environment. But the reason it's done well so far is because it has served as an inflationary hedge as they have continued to reinflate. And so the question is, once we get to that inflection point, then like I said, I think gold is going to suffer with all other asset classes, like I have said all along. But we're not there yet. Gold is kind of the canary in the coal mine there, and we're at an inflection point with gold right now, where there are some cycles due, where we could see a turn point here. So this is an important juncture for gold.
Tim, thank you so much for chatting with us.
You're welcome.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. He was speaking to us from Gulf Shores, Alabama. If you have any questions for Tim or for any of our guests, you can send them to info@howstreet.com, and we'll ask that question for you. Find us on X @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.